Hi, everybody, and welcome back to EBnet Stream. I'm joined today by Kasief Isaacs, who is the CEO of Creation Capital. And given the recent conversation at the IRFA Conference around infrastructure investing, I thought I'd reach out to some of the players out there to have this conversation or to explore this conversation in a little bit more depth. So, Kasief, welcome to EBnet Stream.
Good day, Natalie. Thank you very much for the opportunity to chat. Infrastructure is very close to our hearts as Creation and me personally as well. Now, the way I always think about it or discuss it with trustees and potential investors is, as much as our primary responsibility is to grow savings ultimately for members of pension funds and institutional investors, that savings pool on retirement will not take you very far if the infrastructure you need to enjoy your retirement is not available. So if you don't have functioning roads, schools, healthcare systems, that retirement pot will not take you very far. And that's why we focus quite a bit of our time and effort on infrastructure.
So a lot of the and I don't dispute anything that you're saying, and obviously there is an imperative for investors, retail and institutional, to kind of get behind initiatives like this. I think from my point of view, and having listened to lots of conversations over the last week, there seems to still be an obstacle. Everybody can see the need. Everybody seems to be on this bandwagon or having the same intention, but there seems to be a lag or an obstacle in directing intentional assets into this place. What, in your experience or in your opinion, are those obstacles and challenges?
I think the biggest one that we've seen over the last, let's say, 3 years has been really the absence of sufficient deal flow. Generally, the market is aware of the success of the renewable energy independent power producer program, but there hasn't really been meaningful procurement and ultimately resulting in investment opportunities at scale. We are starting to see a shift in that. Recently we've seen the first wave of opportunities in the water sector, where the government is now looking to partner with the private sector. So we expect deal flow to pick up, and we'll come back to that just now. The other challenges is also, historically, institutional investors typically had maybe 1 to 3% exposure to alternatives, of which infrastructure is one form of alternatives, but it also included hedge funds, sort of anything that just traditionally was thought of as exotic, alternative, made up 1 to 3% of total exposure. So trustees rightfully focus 99% of the time on the listed investment space. And I think there's a bit of a transition required, given that they can allocate more to infrastructure, to get to grips with the sector, get comfortable with the investment thesis, the investment risk, and I think we'll start seeing increasing allocations over the next 12 to 24 months, which will also fit the opening up of opportunities in areas like water. There's also the transmission program to extend South Africa's national grid to be able to take on more renewables onto the grid, for example. So there's a wave of procurement coming in different sectors, and I think it should coincide nicely with the investment market or the investor market increasing appetite for the sector.
I'm so hesitant to ask my next question, but I'm going to. And that is around this kind of appetite that you're talking about. And you so rightly said, the kind of proportion or the percentage of assets invested in these projects, although everybody knows it's an imperative, is around, well, that's less than 3%. Whereas we see in other developed countries, closer to 10%, and sometimes up to 20%. And my question is, if there is a lack of will, is there a potential for legislation? And so this is now the government and the legislators telling us you have to invest 10 or 20% into these types of investments?
Yeah, I think the prescribed assets debate is always a difficult one. So, I don't think it's necessarily an unwillingness to allocate into the space. Remember the last big change in the Reg 28 that opened up infrastructure, and in fact, pension funds particularly can now go up to 45% into infrastructure. That was promulgated in 2023. And it takes about 2 years, for developments like this to filter into the markets, properly. So again, we're optimistic that we'll start seeing a step change, in allocations from sort of tail end of this year into 2026. But it is an interesting discussion because, conceptually, infrastructure, if you think of the nature of the investment, you're looking at a 12 to sometimes up to 17-year investment horizon, with steady, predictable cash flows. And you have to ask, why is there reluctance to allocate when there is almost a perfect match between upcoming liabilities and this asset class? If you think about asset liability matching, then this should fit most pension funds, investment strategies quite well.
Sure.
I think some of it is also the concern around fees and liquidity. Typically private assets, whether it's infrastructure, private equity, other forms of private debt, the fees are higher than what you would pay for listed investments. So that's always a challenge for investors to think about. Does that fees make sense relative to the returns on offer and the risk profile? And that debate's been sort of ongoing, I think, for a lot longer. So that's one aspect and then the liquidity is the second one that I mentioned. I think infrastructure is long dated. That's one of the benefits, is that you see these long dated cash flows, but it also means that it's not as easy to exit these investments. When pension funds, for example, need cash available, it just it's not as easy. But there is a way to address that. So we look at it this way, and if we say, if you couple that inflow, when you look at your investment policy statement and portfolio construction, if you couple that infrastructure investment, for example, with your fixed income strategy or your bond strategy, that gives you the liquidity you need. Infrastructure gives you that steady, predictable returns. I think the bond market is often a lot more volatile, and so you need to think of it as a pairing. It doesn't have to be with the same manager; it can be with different managers. But you need to think of how do I add, how do I marry these two building blocks, so that one can give me that shorter term liquidity, and the other one gives me that steady, predictable returns. And then you start you start getting into solution mode and looking at how these two asset classes complement each other.
Hiya pals, greetings from Sammy. EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channel by clicking the subscribe button below, share this video with others you think will benefit from it, and give us a thumbs up if you are enjoying the content. That way you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za. Ciao, ciao, and bye-bye.
Sure, there's a lot there. And so I guess a lot of our audience would be relying on their asset consultants to bring this to them. But I have this picture in my mind when you say that there's this this kind of expected deal flow coming through towards the end of this year into next year. I'm kind of expecting, and as a trustee, I'd have this expectation that my asset consultant or my employee benefits consultant would be talking to me about, here's opportunities, here's the kind of risks to worry about. You talk about liquidity, here's my recommendation in terms of an asset liability appropriate match, and here's a beautiful solution to this question. Is that an unrealistic expectation?
I wouldn't want to speak for the asset consultants, but we are engaging, with them more often and as often as possible, and asking these same questions, like, how are your engagements with your clients going? Is an opportunity for us to come and present to them. I think we're also quite willing and to work with the consultants to run, information sessions around the sector, what they can expect, how it meets their needs, to help deepen the understanding of the sector. We are engaging with the asset consultants, and they are engaging in turn with clients, and these conversations are happening. But typically, trustees meet once a quarter, investment committees, once a quarter. So there is slow turnaround times to get from that first conversation to, a manager selection process being started, presentations happening, recommendation to the board. The cycle is quite long. So I'm not sure where various funds are along that cycle, but we are starting to see a bit more engagement.
That's such excellent feedback. Before we started recording, we were chatting about the construction of a new portfolio that Creation is busy with, and without kind of a product push, how does one, as an asset manager, go around identifying needs, constructing these types of portfolios? What are you looking for when you put these solutions together?
Yeah, sure. So I think the first decision is, are we going to focus on infrastructure equity or infrastructure debt? So our focus as Creation Capital is on the infrastructure debt space, or the infrastructure credit space. But that's the first sort of big decision point for the manager looking to launch an infrastructure offering to the market. I think the other one then is, infrastructure very broad, right? Anything from rail infrastructure, transmission infrastructure, affordable housing, healthcare, water and sanitation, energy. So it's to pick what are it's number of focus areas for that particular strategy. I think that's very important, because there are different risks within these different subclasses. Right. So if you think, let me try and give you a quick example. If you compare, let's say, affordable housing versus a renewable energy project with guaranteed offtake from an ESCOM, in the housing space, you are taking both availability and demand risk. Right. You need to make sure the rental units are available at the right quality, but you're also dependent on market appetite, right? So rental demand, how many units can I let? What is my long-term occupancy, long-term collections going to look like? Versus a energy project with an ESCOM offtake backed by Treasury guarantee, you're not taking any demand risk. Your tariff is fixed, and escalation of your tariff is agreed up front over the 20-year term, and you focus mainly on availability. Right, so you need to make sure the plant is available, it's operated well, maintained properly, and able to put electrons onto the grid, and then your revenue flows. So understanding the differences between call it sort of sectors within infrastructure and where your focus is going to be is important. We've selected as our core building blocks for the portfolio water and sanitation. I think everyone in the country is aware of water woes generally. I was chatting to someone in Joburg 2 weeks ago, and they said the day before the gym was full because the suburb where he lives didn't have water, and then the next day it flipped around. People in Joburg anecdotally are talking about a minimum a day a week where they open the taps and there's no water flowing. And So water is one, water and sanitation is one, and similarly, the horror stories of sewage running down the streets and all the issues that come with that. So water and sanitation is key for us. And then energy. So we're focusing more on battery storage solutions, and renewable energy. And then the third building block is digital infrastructure. So if you look at the stats from the World Economic Forum, for example, every 10% increase in connectivity adds anywhere around half up to 0.3 to 0.5% to your GDP. And South Africa's connectivity stats, particularly in poorer communities, are still quite weak. So we believe digital infrastructure and connectivity is both an opportunity, but also financial opportunity, and the opportunity to deliver meaningful social impact. And similarly with water, similarly with energy. I mean, it's scary if you look back at 2022, I think it was, the impact of load shedding
Yes.
in the years when it was at its peak. It's estimated at 500,000 job opportunities lost, and about, I think, 2% impact on our GDP. Reduction in our GDP. If you then add transportation, all the issues around Transnet and logistics, particularly on rail, that then takes it to close to 1 million jobs, that was not created or lost. But I think the other benefit of infrastructure, it's very easy to turn that around, right? So as we invest in infrastructure, those job opportunities will come back, and we'll see a pickup in our GDP as well.
It's very exciting. It's very exciting to kind of hear the conversation both at the asset owners level and the willingness, and then from the asset managers perspective around the ability and the exciting projects that are coming. So Kasief, I'm not going to take any more of your time. Thank you very much for spending some time with me today, and I look forward to chatting to you again in the future. Thank you.
Thanks, Natalie. My pleasure. Thank you very much. Cheers. Bye-bye.